Section 1031 is the tax-deferred swap rule. If you exchange qualifying property, you generally don't recognize gain now, and you also can't deduct a loss now. The tax result gets pushed into the replacement property and shows up when you eventually sell. On the EA exam, the first gatekeeper question is simple. Is this a real property exchange or not? After the Tax Cuts and Jobs Act, Section 1031 is real property only. That's a huge exam trap. Before TCJA, you might see exchanges of equipment, vehicles, or other personal property. Not anymore. If it's personal property, the exchange doesn't qualify under 1031, even if the items feel similar. So always classify the property first. Real property versus personal property. So what counts as real property for 1031? Think broad categories. Land and improvements like buildings, foundations, and parking lots. Unsevered natural products like mineral deposits, mines, and wells. Airspace and water rights tied to land can qualify. And certain intangible interests, like a leasehold interest, can qualify too. Also, if state or local law treats it as real property, that can support qualification. Next gatekeeper. How is the property held? To qualify, both the relinquished and replacement property must be held for business use or investment. Personal use property doesn't qualify. A primary residence is the classic non-qualifier. On the exam, watch the facts. Rented out, used in business, or held for appreciation points you toward 1031. Vacation home for family use points you away. Another big exclusion, inventory, meaning property held primarily for sale to customers. Dealers and flippers live here. A developer subdividing lots for sale? Inventory. A house flipper buying, rehabbing, and selling quickly without renting? Inventory. Inventory can't be 1031 property, even though it's real estate. On the EA exam, the phrase held primarily for sale is your red flag. Finally, you need an actual exchange, not a sale for cash. Many real-world deals use a deferred exchange with a qualified intermediary or QI. The QI holds the sale proceeds and uses them to acquire the replacement property, so the taxpayer doesn't take constructive receipt of cash. For this lesson, the key exam takeaway is, if the taxpayer just sells and pockets cash, it's a taxable sale, not 1031. Which of the following is not an acceptable inventory method for federal tax purposes? The choices include allocation method, LIFO, specific identification, and FIFO. Think about which one isn't a recognized method you'd see on the EA exam. Think about it. The correct answer is allocation method. FIFO, LIFO, and specific identification are all recognized inventory methods for tax. Allocation method sounds plausible because we allocate costs in other areas, but it's not one of the standard inventory costing methods the IRS accepts as a general method. Marisol is a direct seller reporting on Schedule C. During the year, she took $250 of perfume out of inventory for her own personal use. She plans to wear it when visiting clients. What's the proper tax treatment? The options include reducing purchases, increasing purchases, deducting on Schedule A, or deducting on Schedule C as promotion. Think about it. The correct answer is to reduce total inventory purchases by $250. When a sole proprietor removes inventory for personal use, that cost is not deductible as a business expense, even if she thinks it helps sales. A tempting wrong answer is deducting it as a promotional expense on Schedule C, but personal use pulls it out of cost of goods sold instead.